Foreign exchange can be important for many non-profit organizations and users of their general-purpose financial reports. NPOs may have transactions in multiple currencies or need to report in foreign currencies. They may also have foreign operations such as a foreign branch, a controlled entity, an associate or joint venture, which carry out their activities in different currencies. This video explains the main proposals for this topic and includes some examples. It aims to make the proposals in INPAG accessible to a broad range of stakeholders to stimulate valuable feedback. INPAG Section 30 Foreign Currency Translation sets out the accounting requirements relating to currencies other than an NPO's own functional currency. This section is largely unchanged from IFRS for SMEs. It provides guidance on how to determine which currency is the functional currency, which can be complex if an NPO operates in multiple currencies. It also provides guidance about how to report in that currency, what to do if you change the functional currency, and what happens if you want to present your financial statements in a currency other than the functional currency. There is also specific guidance where an NPO has foreign operations. And finally, it provides guidance on disclosures. Foreign exchange was added as a priority topic for inclusion in INPAG, following feedback to the 2021 consultation paper that NPOs experience significant practical difficulties in relation to grant funding. Firstly, a common challenge is the impact of adverse movements in exchange rates, where risk is transferred to the grant recipient. Frequently, NPOs make up such shortfalls from their own resources. Secondly, some grant arrangements require the use of specific exchange rates in the presentation of the project finances. These can differ from the rates used for accounting purposes. This can create additional obligations or require a refund of funding. Lastly, some NPOs hold pooled foreign currency in a single bank account, making it difficult to identify the amount of exchange gain or loss associated with an individual grant arrangement. It is important to note that INPAG supports general-purpose financial reporting and not special-purpose financial reports. It cannot therefore resolve all of these issues. But the adaptations included in INPAG Section 30 aim to improve transparency. This video sets out the proposals to standardize the presentation of information and improve transparency with disclosures. The presentation proposals focus on how foreign currency exchange gains and losses should be reported in the financial statements. The disclosure proposals are intended to provide information about exchange gains and losses that are likely to be useful to the users of NPO financial statements. We will cover additional application guidance to help apply other aspects of Section 30 in an NPO context. It is worth noting that INPAG does not propose any changes from the accounting principles set out in IFRS for SMEs. NPOs may have items such as property, plant and equipment that are non-monetary items. If they were purchased in a foreign currency and are held at historic cost, they are not required to be retranslated at each reporting date. However, if they are held at fair value, then they need to be translated using the exchange rate when the fair value was determined. An NPO may have foreign currency monetary items. This includes cash and items such as debtors, grant receivables, creditors, grants payable, loans, or borrowings. Both monetary items and non-monetary items held at fair value must be translated at each reporting date, using the spot exchange rate at the end of the financial reporting period. The underlying principle is that exchange differences follow the same presentation as the transactions to which they relate. Other sections of INPAG will provide guidance about whether a transaction should be presented as part of funds with restrictions or funds without restrictions. A separate video called Common Model for Grants and Donations sets out that INPAG classifies grant arrangements as one of two types. They are either an enforceable grant arrangement, an EGA, or an other funding arrangement, an OFA. INPAG Section 36, Fund Accounting, will be published in Exposure Draft 3. It will include guidance on presenting income relating to grant arrangements as part of funds with restrictions, or funds without restrictions. Much as this is still under development, it is expected that all EGAs will be included as part of funds with restrictions. There are a number of implications for foreign exchange reporting that relates to grants, particularly enforceable grant arrangements. Any amounts transferred in advance, before obligations are fulfilled, are classified as a non-monetary item. These balances do not need to be retranslated. Favorable changes in exchange rates might require a refund to the grant provider. This can be deducted from revenue, or in case insufficient revenue has been recognized, the refund will be deducted from the liability for unfulfilled obligations relating to the EGA. Adverse changes in exchange rates may increase an obligation under an EGA, or create a new one where the NPO bears the risk. Such obligations are recognized as a provision because it is an onerous requirement that has resulted directly from the EGA. Exchange gains or losses can create a surplus or deficit on an EGA. Where permitted by the terms, gains could be transferable to funds without restrictions and be available for other purposes. Where this is not permitted by the terms, the NPO will need to fund a shortfall from its free reserves. We will now work through 3 illustrative examples that demonstrate how to apply this guidance. In example 1, the grant arrangement is an OFA or other funding arrangement. The use of funds is constrained to a designated project. The OFA specifies that grant-related expenses are measured using the spot rate when the grant was received. This is achieved by converting the grant on receipt. The NPO operates in its local currency, the ancient lira, or AL for short. The NPO receives a grant of $50 on the 1st of January 2023, which it immediately converts using the spot rate of 2 AL to the dollar. Revenue of 100 AL and cash of 100 AL is recorded. For the purposes of this example, the revenue is recorded as part of funds with restrictions. On the 1st of June 2023, the NPO incurs expenses of 100 AL. At this date, the exchange rate is 2.5 AL to the dollar. The change in the exchange rate has no impact, because the funds were converted on the day of receipt. The expense is presented in the same column as the related revenue, and an expense of 100 AL is recorded, which uses up the cash provided in January. The grant arrangement in example 2 is still an OFA with constraints, but expenses are charged to the grant using the rate when they were incurred. On the 31st of January 2023, the NPO receives a grant of $50, but instead of converting it immediately, it holds it in its dollar bank account. As with example 1, revenue of 100 AL and cash of 100 AL is recorded on receipt, using the spot rate of 2 AL to the dollar. As the cash is held in a foreign currency bank account, it is a monetary item that needs to be retranslated at each reporting date. The balance is therefore retranslated, using the new spot rate of 2.5 AL to the dollar on the 30th of June 2023. This results in an exchange gain of 25 AL, because $50 is now worth 125 AL. The foreign exchange gain is recorded as part of funds with restrictions, the same as the revenue to which it relates. At the end of the reporting period, the NPO has the original revenue of 100 AL, an exchange gain of 25 AL, and cash of 125 AL. The example shows just one grant in the bank account, but NPOs may pool many foreign currency grants into a single account. If other transactions make it difficult to identify the dollar balance relating to a particular grant arrangement, the exchange gain arising on retranslation will need to be allocated. It will be necessary to choose an allocation method that creates a suitable proxy for the cash balance on the grant arrangement. For example, this could be based on fund balances in the accounting system, but the NPO would need to consider the significance of accruals. Back to our example, in June, the NPO has grant-related expenses of 100 AL. The spot rate on the 30th of June is 2.5 AL to the dollar, so the NPO converts $40 to obtain the 100 AL it needs. The financial statements at the 30th of June will show 100 AL in revenue and expenses, an exchange gain of 25 AL, and 25 AL remaining in the bank account. Because the cash was kept in dollars until it was used, the NPO has $10 left in the bank. The terms of the OFA require that all of the grant must be spent on the project. During July 2023, the spot rate moved to 3 AL to the dollar. The remaining $10 is converted to 30 AL and is spent. This is recorded as an additional 30 AL of expenses, a further exchange gain of 5 AL, and the use of the remaining cash. The financial statements show expenses of 30 AL more than was received as revenue, offset by the exchange gain. The last example is based on an enforceable grant arrangement, or EGA. It has measurable performance conditions, which are its enforceable grant obligations, EGOs. The EGA is agreed in September 2022 and specifies that expenses will be reimbursed up to $50. Grant-related expenses are measured at the spot rate on the date when the expense is incurred. Expenses will be settled once the EGO has been satisfied. The NPO has grant-related expenses of 100 AL on the 31st of January 2023. It records the expenses and its entitlement to grant revenue using the spot rate of 2 AL to the dollar. 100 AL is recorded as grant receivable for reimbursement of the grant expenses incurred. The receivable is a monetary asset, and the NPO retranslates it on the 30th of June 2023. The grant receivable of $50 is converted at the new spot rate of 2.5 AL to the dollar, and is now equivalent to 125 AL. The exchange gain is recorded as part of funds with restrictions, following the original transaction. This creates a surplus of 25 AL relating to the EGA. When Donor B settles its obligation on the same date, the NPO converts this immediately into AL and clears the receivable of 125 AL. As a result of the transactions so far, the NPO shows a surplus of 25 AL relating to the EGA. If the NPO is allowed to retain this surplus for any purpose, then it will transfer it to funds without restrictions. Donor B has confirmed that the terms of the EGA are complete, and a transfer between reserves is made. If the spot rate in June had moved the other way, to be 1.5 AL to the dollar, the receivable would have reduced from 100 AL to 75 AL. This would have created an exchange loss of 25 AL, which when settled, would have meant a deficit of 25 AL on the EGA. Barring any other agreement, the NPO would need to fund this from its own reserves. These examples are designed to demonstrate the principles set out in INPAG, rather than provide an exhaustive set of all possibilities. Exchange gains and losses must be disclosed where they contribute to a surplus or deficit on grant arrangements presented within funds with restrictions. They must be disclosed separately from any other factors that may have led to a surplus or deficit on an individual arrangement. The disclosure should provide details of the gain or loss in the period, as well as amounts brought forward and carried forward, where the grant arrangement covers multiple years. This is intended to provide transparency over the exchange rate exposures and improve understanding of the source and use of an NPO's funds, particularly where exchange rate losses have to be funded from an NPO's free reserves. Where exchange gains or losses lead to a transfer between funds with restrictions and funds without restrictions, this will be shown in the statement of changes in net assets. An explanation for these movements is required in the notes to the financial statements. An NPO's functional currency is not an accounting policy choice, but is identified through an assessment process based on a number of factors. INPAG has been adapted so that the currency of grants and donations, both received and paid, is taken into account in the assessment. For example, if an NPO receives grants and donations in a number of currencies, pays for goods and services and pays salaries in the local currency, then the local currency is likely to be the functional currency. The scope of the indicators has been extended to cover grant arrangements. These may be material, particularly when there are multi-year grants that are paid in advance. Where the NPO has foreign operations, such as a branch, controlled entity, associate or joint arrangement, the degree of financial interaction and dependency between the controlling NPO and the foreign operation will create additional factors to consider. This video describes the principles to be used in presenting foreign currency exchange gains and losses, and how this may impact the reporting of grant arrangements. It describes proposals for some additional disclosures. This provides transparency about shortfalls from exchange losses that cannot be recovered, and the extent to which an NPO may benefit from exchange gains. It also provides additional guidance relating to the assessment of an NPO's functional currency. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes specific questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 15th of March 2024.